Hi everyone, Tom here from Hedge Fund Tips. Welcome to our fourth ever video cast and market commentary for the week ending November 22nd, 2019. So the first thing we're going to cover today is we put out a note today about earnings estimates holding strong for 2020. They came in this week at 178.70. So while they're down a few cents from last week, the growth rate actually bumped up a bit from 9.7% to 9.9%, and part of that was attributable to a modest takedown for 2019 results. But markets are forward-looking, so on that 9.9% growth, we did an article earlier in the week about where's that going to come from. And the name of the article was "The Last Shall Be First," and it looked at the three worst performing sectors for 2019 are projected to be the three best performing sectors of 2020, with energy leading the pack at 23% earnings growth, followed by industrials at 16%, 16.7%, and materials at 14.7%. You can click here to review that. And that makes sense considering this week the rig count came down another 3 rigs. The rig count now stands at 803 rigs, down 276 rigs from this time last year. And sooner or later, that's going to start to affect the supply-demand equation. I know OPEC, there were some rumblings this week that they're going to potentially do some cuts in coming weeks in December on top of it. So things are setting up with easy comps, etc. And we've talked about the exploration and production sector. We're going to go into that later in this article, but the key is that earnings growth is there, and the last time we had double-digit earnings growth was 2016 going into 2017, and from fourth quarter around this time in 16, anticipating that 11% earnings growth they got, the market rallied 37.8% in the next 15 months. So we're knocking on the door of 10%, and we've moved up a little bit, but could certainly have some runway on that renewed earnings growth, which is what the market's needed. So there are going to be some factors that are needed to ensure that gets locked in. Furthermore, we picked up another 10 basis points on Q3 earnings with 4%, 20 companies left to report, but we're now at negative 2.2% for Q3 relative to expectations. About a week in, they troughed at negative 4.8. So we've really picked up a lot. Earnings have, 75% of the companies have beat. And but that's backward looking. Forward looking is what we're focused on, and that's the message of that article. The second thing that people talked about this week was the Russell 2000. While we've had this rally in the last 6 weeks, the price of the Russell has lagged, and bearish folks use that as a caution sign, and that can make sense. But we took the top 30 weight components and just looked at the numbers this week. For 2019, the estimates actually have climbed in the last 60 days by 2.22%. And for 2020, estimates have come up in the face of all this trade uncertainty. Estimates have still come up almost 1%, 0.94% for 2020. So they're humming along, and that's definitely a positive sign that the underlying is strengthening. Next, we're going to go to our fun article, but it has a chock full of detail, which is the TikTok Get Up stock market and sentiment results. So this week, there were a lot of headlines about TikTok. TikTok is too Chinese. It's not Chinese enough. So first thing I had to figure out was, what the heck is TikTok? And it turns out the U.S. government was worried that the Chinese government was using this social media app to get into U.S. computers and phones and data. So my take is if you see a new Chinese startup hedge fund outperforming on using spreads on U.S. large caps, we'll know they hacked my computer through TikToks. But until then, I downloaded the app. I set up a handle, Official Hedge Fund Tips. You'll be able to see I don't know what I'm doing. But so I could see what all the commotion was, and I was blown away to learn, number one, 1.5 billion downloads. I'm probably one of the few people who hadn't yet downloaded in the developed world. But it's just amazing to see all ages. It's a youngish app, but now older people are getting on it. And One thing was clear: the U.S. has maintained its hegemonic hold on global dancing power. People are just having a blast on this app, while at the same time we're bartering to retain our economic supremacy. We've got the dancing handled, but we've got to get this phase 1 inked and move forward globally. So, I don't know that you'll see me dancing on TikTok anytime soon, but never say never. It looks like a lot of fun. So one of the key themes, the dance themes of TikTok for this week and the stock market, is a song by Blanco Brown called Get Up. It's called Get Up, and lyrics are take it down now and then bring it up now. So we'll just play a little bit so you can hear it, and then we'll get on with it.
To the right, to the right. To the right. Now take your left hand and put it on your side. Put it on your side. Gonna roll your shoulders. Do the slip and slide. Do the slip and slide. This next part's my favorite part, cause it's time to shine. Gonna do the two-step, then cowboy boogie. Grab a sweetheart and spin out with me. Do the hold down and get into it.
Okay, so now you know what 1.5 billion people are doing on TikTok. And why that's growing like a weed. So the up and down market is related to the trade talks and the fact that we were short-term overbought, which we talked about last week. You might get a consolidation sideways in price or a slight pullback. And we saw a little bit of that rockiness this week, and that was thematic of the song. So how do those lyrics apply to this week's stock market commentary? Take it down now, bring it up now. And we covered last week in our videocast and article the 7 conditions precedent that bode well for continued improvement in equities over the intermediate term. Short term, the indicators were slightly overbought, and we discussed that. You can go through all that. But intermediate term, things are set up very, very well. And the first condition was that institutions were underweight when the yield curve inverted in August. They all went to cash and bonds, and now they've got to chase the benchmark. So structurally, the market is good into year end with managers chasing. Second was the yield curve inversion was actually a bullish sign. In the last 3 times, albeit a small sample, when you had these inversions at the red line, the peak was on average 18 months out and on average over 30% appreciation. So considering we just barely inverted in August, we should have some runway to go. And if it's like anything like 95, there's possibly another material leg in this, but for sure on the inversion, because it did in fact invert, we should have that runway. Third, earnings are strong. We just covered that, close to double digits for next year. Fourth, massive liquidity, and we're going to go into that into this article. But the ECB is back in the game at $20 billion a month. The Fed we'll talk about in a moment, and Kuroda, Bank of Japan, never left. Multiple expansions likely if you're part of the camp that believes that we're at the end of the cycle. Usually you don't peak at a 17 times multiple. It's more likely 19 to 21, 22 times at the peak, and we've got a long way to go to get there. Sixth was that 10-year expansions. The narrative was that we've been rallying for 10 years, but the truth is that if you look back 100 years, most of these secular bulls, this one, are 16 to 20 years, and we've only broken out in 2013. We've been going for 6 years. So, it doesn't preclude that 87 major corrections in a secular bull, and that certainly could happen at some point. But we've kind of paid our dues with this long-term consolidation. We should have some more room to run. 7 is the impeachment hearings being noise. Probably nothing will happen in the House. It remains to be determined, but certainly going nowhere in the Senate. And the last time you had the House hearings in similar conditions in October 98, the market rallied 56% in the next 18 months. So that's just market noise. So getting back to this market now that we've covered the conditions precedent is the Fed liquidity. And I made the joke that if the Chinese government was watching through my TikTok app, one of the things in the Fed minutes on Wednesday was a discussion of the standing repo as a possibility that the Fed's looking at. And basically, they've just been buying on the short end, and you can see the impact it's had on the balance sheet in the last, since August 28th, we've added, the Fed has added $288 billion of liquidity. They've increased the balance sheet by $288 billion. So if they did move ahead with something like a standard repo at that pace of $115 billion a month, you're looking at unwinding all of quantitative tightening. What took 2 years, they tightened by $785 billion. They sucked that liquidity out of the market, which caused the slowdown this year. There's always a lagged effect. So they tighten for 2 years, you get a slowdown 6 months later. But at the pace, if they do go ahead with this standing repo at 115 billion a month, we'll unwind all that by springtime. So that's very, very constructive to have that kind of liquidity in the market. And that's why I said to the Chinese, simply put, it means that it's in your interest to cut a phase one deal, buy some pork, gas, oil, and beans that you need and use anyway, because Jay's got our back regardless of what happens. And you can see that in the numbers here. Chair Powell has totally reversed from being too tight at the end of last year into slowing growth, and now he's easing into what's going to be rising growth, close to 10% of earnings growth. So, don't bring a knife to a gunfight. You don't want to fight the richest guy in the world, that's for sure. And so that's really about the easing and the Fed and the conditions precedent. So you can review all that. Some short-term indicators we covered. Sentiment came down this week a bit from 40% bullish to 34%. So, participants curbed their enthusiasm a bit on the uncertainty around trade. And the fear and greed index confirmed that. That came in 13 points down to 74. And National Association of Active Investment Managers dropped their equity exposure from 92% down to 72%. So that late money did get scared out. And once we get some positive phase one headlines or something else as we get through the last 20 companies of earnings, et cetera, they're going to have to doubly scramble to get in position for year end. So this is, in a sense, what was anticipated, shaking out that late money, but now we could really move on constructive outcomes here. So what? For those people that are skeptical about the deal, let's look at the actors and what's in their interest. And, certainly President Trump, he's got re-election coming in 2020. He's campaigned on this. He's wanted to get a good deal with China since before he ran, and he wants to deliver on that for the people and come through. Time is ticking. So that's very, very important. Number one. Number two, certainly wouldn't hurt in his shoes, to displace some of the noise coming out of the House about impeachment. So it's timely. Get it done. Get 2 wins. Kill 2 birds with 1 stone. And the country's better off for that. Second, the Chinese desperately need this deal to recover their growth. We're going into growth. They're declining at this stage. It's really hit them hard with all the supply chain moving out to different options like Vietnam, et cetera. So Indonesia. So China needs this to recover their growth and their political stability. Okay, that's eroding by the minute. You see what's happening in Hong Kong, and the longer that goes, the harder they're going to have to pull back from the brink. You see Hong Kong really devolving on a daily basis. And lastly, Wall Street needs this deal to maintain their earnings estimates for 2020. That is absolutely essential. The longer this drags on, the harder it's going to be for analysts to keep their numbers up near double-digit growth for 2020. So everyone wants to get this done. It seems like they're there. Now they've just got to tuck it away, and everyone can, both sides can win and move forward. So that was a key point. Look at the actors, what's in it for them, and everyone wins by getting this thing signed up. And then after the election, they can, play around if they want to play tougher with phase 2 or whatever they need to do. That's something that is to be determined. But right now, let's just, get these tariffs off the table, get something fair signed, and get growth back on the table so companies can plan and things can move ahead. Last week, when we discussed the short-term indicators in greater significance and talked about, short-termism, and we talked about trimming the ones that have run huge off of the August and September lows, but also any new risk putting to work to be looking at laggard sectors and laggard stocks that are just beginning to have money rotate into them. And we pointed to our September article. We did an article on Biotech. You can find it here, where earnings were going up and the price was going down. It had dropped 9% into mid-September, and it was just all the political overhang noise about Medicaid, Medicare for all, etc. So since this article, after this article, the last 6 weeks, biotech is now up 20% in 6 weeks. So the reversal has been incredible, and there's still opportunities for growth in that. There's no question about it. One of the weights in the IBB index that I've spent a lot of time on is Regeneron, and that has just had a monster move from like 270 to now 360 in the last few weeks. And they reported earnings. Earnings per share was up 13.6% year on year. Revenues were up 23% year on year. Piper put out a note. They liked it for, well over 400 because the $1 billion buyback. Their eye disease franchise, Eylea, beat big in Q3. They think that can happen again moving forward. And they have this drug Libtayo. The overall response rate in first-line non-small cell lung carcinoma is, they feel, at least competitive with Merck's Keytruda, which is a $10 billion franchise. So, Citi was looking at Keytruda as being, even just a quarter of that by, 2027, $2.5 billion in lung cancer sales. They're bullish on the Dupixent, the asthma franchise, and they see that hitting 10 billion peak sales versus the current run rate, which is already at 2.5 billion. So this is exciting times, and that looks like, and it's still trading at a very low multiple, and there are lots of them in the sector. So there's still opportunity in the right biotechs. I think this Regeneron can really continue to move, and that's been really, really exciting to see. The second sector, so biotech's already had a move off of that September article. We put out an article on exploration and production a few weeks ago in October, and it's up a hair. It's basically flat since then. And I was asked on Fox Business this week to talk about Warren Buffett's investment in Occidental Petroleum. Not only did he do the $10 billion preferred, but he's just added another $300 million of equity on top of it. And you can just see a quick minute on that right here.
Well, it might be even earlier than that, Thomas. Down at the NYSE, there have been many a stock that Buffett has bought. They initially spike, then the names sometimes moderate depending on the headlines. But he's got an incredible track record for purchasing most companies that end up adding value and adding shareholder value too. So what do you make of this move? And at a time when we do see markets at record highs, it's an interesting play. He usually waits till we see big pullbacks.
Well, Liz, where else are you going to find value with the markets up? Right. I love the Occidental deal. $300 million behind a $10 billion preferred. It's just phenomenal. This combined company is going to produce 1.3% of the world's demand on a daily basis, 1.3 million barrels a day. And this sector is down and out, and that's what a value investor does. He takes a long-term leverage bet on oil in Occidental. He backs it up with some equity plays, and this is just going to be a phenomenal deal. This sector is the worst performing sector, exploration and production, for this year. Next year's earnings, we're expected to have the highest earnings growth, 25% earnings growth in exploration and production.
Yeah, I think you're right on that. Phil, we are...
Okay, so that just a summary of one of the components of the sector. But in this article, which you can review, I went through the top 30 weights of the exploration and production sector. You see right here, it's trading down to great financial crisis lows and the 2016 oil depression lows when oil was at $25 a barrel. So effectively, the top 30 weights that had comps in 2009, the earnings power in this long period has only increased by 32.4%, which is anemic, but the price is the same. So you've had earnings growth and you've had no reflection in price. Plus you've got forward earnings now 25%. So basically 55 some odd percent and no price improvement. And that type of divergence is the same type of setup we had in biotech. And I think there are some opportunities there. Obviously, following Buffett's never a bad idea, and there are many others to look at. So you can have a look at that. And finally, the last point that I would just keep in mind is the pressure is building on the Chinese to get something done. The pressure is building on the U.S. to get something done. And it's not clear that phase one is fully priced in here because companies are not planning and spending as if it's a done deal. So the one thing to keep in mind is if we do get something inked here, and it could be sooner than later, estimates could start to come up, multiples could start to come up, the liquidity is there, and I would never bet against the possibility of $100 billion a month from the Fed and $20 billion a month from the ECB. I'm not betting on future forward rate cuts. I don't think we're going to need it. The liquidity can come from dealing on the short end and forcing some of that money out on the risk curve. And the last thing to keep in mind is things don't happen overnight. So we had $785 billion of quantitative tightening over 2 years. And then 6 months later, we're seeing the slowed growth, 3 negative quarters of earnings growth, just like we had in 2016 before we took off and the market rallied 38.6%. We just started easing this summer, 75 basis points of cuts, and now $288 billion of balance sheet expansion. So there might be, a little lag, but that you could start to see increased growth. You could start to see earnings estimates come up, and certainly the discount rate being lowered. You could certainly see the multiple expansion to a later cycle multiple if you're in that camp. So the theme was don't fight the Fed. And I hope that was helpful. We'll see you all back here next week.